Great. So welcome to our fourth ELEA webinar on how to mobilize private capital to spark social innovation. Rosa from Spain, Teresa from Zurich. So here we are in a new day. And the idea of today's webinar, and let me share with you a little bit here where we are. So the idea of today is to actually start talking or focusing, and because there is no one size fits all, as you may obviously all of you know, when we talk about impact investment, and different regions in the world, different types of investors will have different concerns and different problems. So we are very privileged to have Sertac Yeltekin today to talk to us and to chat with us about Asian markets and the role, especially private equity and venture capital play in this spectrum that we talked before. No, so talking about this, and let me move a little bit here. I wanted to start with a picture that actually really, it was published a year ago and kind of puzzled me a little bit, and it was kind of very provocative. So what do you see? Use your chat for now to tell me, what do you see? Do you know what picture is? This is the picture from a year ago. It appeared on HongKong1.com. So what do you see? Can you see the picture first? Venice. Carlos is right, that's Venice. And Chinese shopping in Venice, according to Mafi. And it's true, you see at least two Asian women with big bags. Consumerism, even though there is a crisis. And I think Candice is referring to the flooded Venice we see, and we talk about climate crisis. Priorities of capitalism, says Nicolo. And Tommaso is saying rich and poor differences. We don't see a lot of poor here, but you are right. We see this idea of wealth or purchasing luxury goods in a beautiful touristic location like Venice. And if you think a little bit, and that never give up actually, no, even under a crisis and even under a floor, we keep buying, no. And if you think about that, and I wanted to provoke you a little bit with this picture, because Asian markets have been the driver of growth, not only of the luxury industry that actually was a huge push, but a lot in tourism and in a lot of different markets. And if you think about the amount of billionaires or a billionaire growth and in Asia, it has been outpacing Europe and the US at around 10%. And it's even estimated that this will keep happening, especially after the COVID crisis hopefully is over. So we have very different views of Venice these days, and we have a very empty Venice with blue skies and unpolluted waters. But we are still thinking about when we go back, when we have a new normal, can we really have a green start? And what does that green restart means in different markets? And what would it take? And Sertac is going to talk to us about how much is the concept of impact investment, how popular it is or not in Asian markets, and what are the specific challenges in these markets. So before also we start, I want to share with you a poll. So I'm going to open a poll now, and I would like you to vote. And as you see, there are you have three options. So what I wanted to answer is, if you have, so now I'm actually last week, if you participated on the webinar, we gave you 200K to invest. Now I'm going to ask you, what would you do with your hard-earned money that is in your pension fund? So your retirement depends on it. So if you had to invest that money and you have a say on where that money should go, where would you invest it? Would you invest in a portfolio with well above market returns, but no measurable impact? So, and even I would even provoke you a little more with some sin stocks there, or some things that you know not necessarily good for the environment or society? Would you invest your portfolio with below or at least equal market returns with a proper prospect of having a good, positive environmental, social impact, or will you do part on part both? No, and it'll be interesting to also to divide what percentage you will do, but at least we have a little bit of a say on that one. So we could add actually, as Ivan is saying, the split, but we'll get into a lot of detail. But it's just to have an idea. And as you all seem, and I will share with you the results, as you all seem very diplomatic, we have 67% of you saying that you would split the portfolio, having at least, it'll be interesting to your part. And we have a 10% still that will say, okay, don't mess with my money. I want higher than market returns, and other people that are willing to take some trade-off, or at least. So we will continue this discussion to see in what place Asian markets are in this spectrum. And we are going to see also that this is actually an important question for many investors, and even when we're going to talk the following month in May about ESG integration and other ways of integrating social environmental standards, how the business case is actually very important. So when we started this webinar, our first webinar with Peter Wolfley, and we talk about philanthropic impact investing, when we define impact investing, we said that an impact investor, or what made different an impact investor, was actually that he or she actively places capital in enterprises that generate first a measurable desire. So it has to be an intention behind beneficial social or environmental outcome. And we added a condition that was called additionality, that we said that would not occur if this investment didn't happen. No, and that there was also expected financial returns that could range from highly concessionary money, like we have a philanthropic impact investor, or market or above market returns when we see an impact first type of investors. So what we're going to do today is I'm going to kind of remind you a little bit of the framework, because our focus today is going to be precisely on this part of investment first, or returns first, finance first type of investing. And we're going to talk about VC money, venture capital money, and private equity, and what role in this impact investing spectrum they have, and how do we, again, let me try to get, I think I still have my poll here. Okay, so I'm going back. Sorry if I kept the poll back there. So, and how from here, how do we go and understand what are the specificities of impact investing in Asia? So we have, what we're going to do is we're going to relax this idea of additionality, because especially, and this is kind of usually a controversial side of the definition. So the typical definition of impact investment is really a very simple one that says that investment that are made with a positive intention, so intentionality still matters, to generate positive and measurable social and environmental impact alongside of financial return. So in order to be an investment, you need the financial return expectation. In order to have impact, you need intentionality and measure of impact. So this important, or if you want, as we're talking about this side, I also would like to tell you, because very soon we're going to start talking to Sertac a little bit about the dynamics. And I wanted, in the previous webinars, we had him with us too, but I would ask to introduce you to Patrick Reichardt. Patrick, can you turn on your camera? So Patrick Reichardt is actually a research fellow. Say hi. Hello.
Hi, welcome. Thanks for joining us. Yeah.
Good. So Patrick Reichardt is a research fellow here at the Lea Center for Social Innovation. If you're interested, just check our page and you will see the different lines of research that we're doing together. And he'll be supporting us with the Q&A. So let me just a quick logistics. In the bottom of the page, because we have used up to now the chat. So when you have specific questions to Sertac, to our speaker today, please write them in the Q&A. And the neat thing about the Q&A, because it can get very crazy and lots of questions happening at the same time, is that if you click on the like icon, you can upvote a question. So if you see a question that somebody else asked that represents and you think is a really good question and you want me to take it out to ask Sertac, please outvote that question so I can see it. So in the bottom of the page, you're going to see the Q&A, and we are going to use that to have some questions from the audience and try to make this webinar very interactive. So without more further ado, because I think I created already enough expectation, I want to thank a lot Sertac Yeltekin. He's a senior advisor and chief operating officer since 2017 at Insitor Partners. Insitor Partners is a licensed Singapore-based venture capital firm that specializes precisely on impact investment in South and Southeast Asia. And a nice or a neat anecdote that Sertac mentioned to me when we were coordinating for the webinar is that precisely the name Insitor comes from Roman mythology, and it's interesting because Romans also had environmental problems, it's not just us that were having, and they actually had specific gods and goddesses and lars associated with the natural environment. So every major and minor activity of a farm had a deity, and Insitor was precisely the deity of sowing. So I think that name is very, what I would say, very inviting, and I wanted to share with you the anecdote because you will see that how impact is really at the heart of Insitor. And he also has a very long experience he's also a founder and managing director of Zinkforce, where he does specialized social and finance management consulting. And last but not least, and if you've been following these webinars, you know that part of the objective is actually to build a community of like-minded people interested in mobilizing private capital. So Sertac is also an executive in residence at IMD Business School in the Singapore campus and has supported in many endeavors with different of our participants and in different things that we do. And he's also a speaker, and he loves education, and he works as a lecturer in many other universities. So thank you, Sertac, for being here with us. And let's start with a very general question, but I think it's at the heart of what we want to talk today is what is Insitor and why impact investing in Asia? So what countries in Asia do you think are more interesting or more open to impact investment opportunities, and what do you think is more attractive?
Hello.
Hello.
Hi. Okay. Thank you, Vanina. Thanks for the introduction, and thanks for having me here. And I would like to also thank everybody who was virtually present in this 1 hour session. And I'm really grateful that you all came. So I hope it's worth your time and energy. Insitor, where does it come from? You've already explained. Let me give you a little bit of a background. Now, Insitor has been active roughly about 10 years. It was established initially in Cambodia as an impact investing fund, started managing a seed fund, and then it grew out of the seed fund into a DFI-backed fund a couple of years ago. It's now, since I came on board a few years ago, it's established in Singapore as headquarters, where we coordinate all of the activity, and we predominantly invest in 4 countries as of yet. But this is part of our mandate. In the future, it might be even more countries, but we're very much in India. We have colleagues on the ground in Bangalore and Mumbai. We have investments and investment teams in Pakistan, out of Karachi and Lahore, and in Myanmar. We're also present in Yangon, and the Mekong investments are mostly out of Phnom Penh in Cambodia. Now, there are many impact investing intermediaries firms in Asia, and we're one of the early pioneers in the sector. There are many others who operate in other countries. Their portfolio might be much more Asia or even Asia-Africa based. Ours is what we would call South and Southeast Asia. Now, what is the purpose of InStore? The founders started establishing InStore with a very clear purpose in mind. And the purpose was, let's start deploying capital to small and medium enterprises that actually produce goods and services for populations that do not have access to those services. So these are people who are underserved, as the jargon goes, and let's try to actually deploy capital to those who don't have access to capital. So with that purpose in mind, it started, and with that purpose in mind, it still continues. The numbers, the different sectors that we're investing in are pretty much covers all of the basic needs of the populations who do not have access to full economic opportunities. So we're talking about affordable housing, we're talking about financial inclusion, microfinance, we're talking about affordable healthcare, utilities such as water, clean energy, education, and agriculture. So it's a very vast and diversified portfolio. And the idea is to actually focus on companies that are early stage companies, because there's a lot of activity happening in and around startups and in growth stage companies, but actually the amount of capital that early stage companies that have actually gone from sort of a startup phase have started, churning out revenues, but not necessarily have access to capital that would make them grow.
And is there a pipeline? Is there a good pipeline for those type of companies? What is the stage of development in Asia of the social entrepreneurship ecosystem? Yeah.
Yes, exactly. And the slide that you see, I don't know if you have access to the slide, there's sort of the maturity of Asian countries as social economies. Now, for example, this is very emblematic. One of the issues that everybody sort of the $1 million questions is there enough pipeline? If we deploy, if we commit capital to you, do you think there are going to be enough companies out there that you can weed out from? This is actually absolutely true. There is enough pipeline. For example, over the course of a few years, we've weeded out maybe 400, 500 companies. We have an investment process whereby we go through stages and then look at which of those companies we can actually put in the long list and then short list. Even in those 4 countries, we're talking about hundreds and hundreds of cases of early stage companies that might fit into our portfolio of specifications. If you add it up with startups and growth stage companies, I think we're looking way into thousands of companies only in the countries that we operate. Now, when you look at Asia, we don't have one Asia, and this is, I think, very, very important that anybody who lives in Asia knows this, but who doesn't live in Asia may not know this, but Asia is actually Asia's. When you talk about a number of different ecosystems, there's India, there's China, there's Korea and Japan, and there's Southeast Asia. We're talking about 4 or 5 different ecosystems, really large entities. Some of them are very advanced in terms of social economies. Now, this is a study done by Asian Venture Philanthropists Association, and they do wonderful studies. If you go AVPN site, and you can see a lot of information on impact investing. India is a very, very lively, it has an incredibly dynamic social economy. Some numbers that I have actually put it down, there are about 3.5 million NGOs only in India. There are 2 million social enterprises. There are about 3 to 4 million enterprises that actually can be within the social impact sphere. So we're talking about the very lively social economy. The Indian high net worth individuals are the most sophisticated high net worth individuals in terms of deploying capital for philanthropic and venture needs. So it's a very highly developed market in that sense.
We had a question.
And there's a lot of pipeline.
We had a question on the comparison between India and Japan, and because they both seem to be in the high maturity level. How can that be? They're asking.
Yeah, well, you see, these are all sorts of different. It's an index, so it's based on a number of factors, and the factor is usually looks at what is the state of the social economy, and the social economy is defined as the whole ecosystem that the social economy depends on, from companies that actually operate as social enterprises, the legislative aspects, if the country is actually supporting the development of a social economy, the number of investors available, and the investor sophistication in deploying capital. Now, even if we're talking about two really completely different countries, India and Japan, according to those factors, they actually fulfill all of the characteristics of a very highly developed country. So the factors themselves actually determine what's the ecosystem look like.
We had two webinars before where we focused when we were talking about intentionality and maybe more, since we're talking a little bit about standardizing, we talked about is the SDG investing. No, I know you also do some SDG investing and focus part of your investment. What do you think are the SDG needs investing in Asia, and how does Insitor address the SDGs?
We do have the SDG framework basically became very widely used over the last 2 years. If you look at, even if it was actually around, I think, well known to everybody since 2015 almost. But if you look at the sector asset management and the sector impact investing, which is a subset of this asset management sector, there are the SDGs came to be used over the last few years. Now, but in any case, I think it's an excellent framework to cover the societal needs, and it's a great framework to actually look at where your positioning is as a fund. Now, we tend to be around SDGs such as the no poverty, quality education, healthcare, clean water, clean energy, reducing inequality. So when you look at the slide, the number 1, 3, 4, 6, 7, 10, those are the predominant ones. And then if you actually deep dive into the companies, you may actually see more SDGs covered. We actually start from really, really important, very simple lead indicators. For example, you see some of them up there. 12 million young people will be entering India's job market each year, every month over the next 2 decades. Now, these are humongous amount of numbers, and you need a whole system whereby there should be companies that actually cater to making sure that these people have the right skills to be employed in companies. So what we do, we actually go seek out companies that cater to those needs. So we start from social needs, and then based on that, we construct a portfolio that might actually reflect those social needs. And there are many, many indicators that we can find. In Asia, I think there's a plethora of different types of indicators that you find. If you look at different countries.
Since you're mentioning, I think, can you give us some example of your investments? I've been following the things you're doing, and I know you recently had some exits and quite successful. So to know a little bit what kind of investment you do in your portfolio.
Absolutely. Well, you can all go to the Insitor Partners site and have a look at that. You'll see all of the portfolio companies. So, as I said, we're very much active in financial inclusion, affordable housing, affordable healthcare, affordable medical diagnostics, water, and clean energy. to name a few. But the last 3 exits that we've done, these are very important exits. They've been successfully conducted. Biosense, which is an affordable medical diagnostics company in India, and the buyer was a global diagnostics company. And Biosense actually had a product that could, in a very affordable manner, measure the level of anemia or other diseases using blood samples. And it became, over the years that we supported, it became a very, very robust company. And now it's going to be part of a much larger network. Aviom is a housing finance company in India that we supported in its growth phase. And now it's being acquired through a secondary deal by another company that was already a shareholder structure, but wanted to actually expand its operations in India. And that also has been a successful exit. Joma Bakery is a bakery and cafe chain in Vietnam, Laos, and Cambodia. And in the initial stages of its foundation, it started focusing on hiring people who were actually left out, people who had enormous experiences around human trafficking. And Joma became a very successful chain. It's now management buyout was done, and the current managers and the founders actually bought it out. But we supported its growth for many years. These are some examples. You'll see the whole portfolio actually on our website.
Right. Since we're talking about successful exits, and in the previous webinars, we talked about philanthropic impact investing, and obviously, and we talked about impact first, and you're bringing the perspective now of a VC, venture capital for impact investing. Is VC too risky? Do we really need VC money for impact? Why to choose to play in this part of the spectrum, if you want, and what are the advantages and disadvantages?
Well, if you look at impact investing space around venture capital, support and capital deployment, it's actually not, as an industry, not very different from the typical mainstream VC industry. It does entail risks. It may look like a risky investment depending on the type of portfolio that you manage, but it actually shares a lot with the mainstream's way of picking companies and making them at early stages grow. Now, if you look at the sort of the slides over here, you will actually see that the traditional impact investing, which is roughly around 230 billion, is composed mostly of private debt and private equity. These are investments done by high net worth individuals, funds, banks, foundations, DFIs, and they pretty much occupy the space around venture capital. They might be supporting companies that are at startup phase, that they're at early growth phase, or at later stages of the company's sort of maturity. What is happening here is that the investors actually look at a portfolio that has a number of risks. And the risks, when you look at overall the venture capital industry, and we're talking about data that goes way back to 50 years earlier, roughly 75 to 80% of the companies actually have below market returns. I'm talking about the mainstream, irregardless of impact investing. So there are only 20% of the companies actually that yield returns that cover the loss of all the other 80, presumably. This is actually the 20% that actually yield is so high, or the upside could be so high that the investors are lured by getting into this investment. Okay, so this is the rationale behind impact, the venture capital.
Vincent is asking you a very nosy question, I think, yes. Since you mentioned exits. He's saying, what was the return on those exits, and what is usually your expectations of return in the VC impact investment side from your own perspective, if you can share with us.
Sure. It's a very relevant question, and it's a pertinent question.
Since we asked in a poll, to people if they were willing to trade impact and returns, and we are saying that returns first. So I thought this is a pertinent question.
Absolutely. Well, the impact space over the few years, the investors are not only looking for social return, they're also looking for financial return. And I think what distinguishes impact investing from any other philanthropic activity and all that is that there's a very balanced sort of social and financial return. But if the social return has to be there, environmental return has to be there, it has to be intentional. But if you don't have a good return, most of the investors actually may not be willing to give you money. That said, we basically as a team, our founders, myself, all of us come from a more sort of a financial background. We do actually care a lot about looking at companies, whether over time they can yield, they can be sustainable. The market's expectation around returns, and I'm talking about, we're in general, the fundraising phase and all that. We're talking about between, 12 to 15, 10 to 15 bracket of internal rate of return. So that could per annum, and that's a gross fact. And then if you actually take out all the other costs and all that, we're talking about a net return of 6-7%. These are hefty returns. I mean, this is no joke. So, which means that the bar is really high, and the bar is high because you're not investing in companies that do not produce social and environmental return. And many mainstream venture capital or private equity firms, they can actually maximize the return because they may not care. Whereas in impact investing, it's an intentional way of saying that, okay, if the first hurdle is passed, if the yield of social and environmental returns are there, is this company also on top of this producing value for shareholders?
Josaki is asking about the exits you have, if they were going to the public market or to a secondary fund or a secondary market. I think you mentioned of that, but I think it'll be interesting to understand.
Well, the exits so far that we've done, they're not part of an IPO or being quoted in the public markets. They're basically a buyout from a global medical company. Another one is a secondary buyout. So current shareholders who are not listed companies buy out the shares of other investors, or a management buyout. So in none of these cases, it sort of goes into an IPO. Well, when you talk about IPOs, actually, again, there are a lot of myths around this in the market. Now, if you look at IPOs, they usually take place at stages where the company is at a growth stage, which is so it has passed already its early stage phase. It churns out big yields. They're not absolutely in earlier stages as many of our companies are in terms of growth prospects. If you look at mainstream PE, VC, you never see anybody being quoted on the market because it's a startup. They, pump up many of those companies with a lot of cash, and you know what I'm talking about. And then after many years, if they're lucky, they go in and actually quote them on the market. So IPO is one of the instruments, but not the only instrument.
And this is actually a very interesting issue, and I'm probably organized, and I will invite you, Sertac, to in the near future to probably a conversation with an entrepreneur and with a project that is happening in Switzerland about creating a social stock exchange. And if we need, because we know that right now it is a challenging side for impact enterprises to actually go public, and do we need a different market? And I think in the last 15, 20 years, as your own experience, we are seeing a lot more successful exits and social enterprises that have scaled up and gone to that growth stage that you're mentioning. So, but we're still the traditional ways which you're actually mentioning right now. Other questions that are coming from people, and I think Derek is asking us, what do you think is the effect of COVID crisis? And if you think also that after this will create an opportunity to accelerate impact and responsible investment. So how do you think the COVID crisis will affect the sector?
Yeah, thanks for the question. We're actually in the midst of a big crisis. So basically, none of us has a crystal ball to see what type of models are going to emerge and how they're going to look like. But definitely within this crisis, one of the biggest issues that we're seeing is that the economic activity has collapsed in many countries. Now, in a sort of luckily in the countries that we are active in, economic activity has not been as damaged as much as in the West, in Western Europe, or in developed countries, in other parts of the world. But there's a huge disruption in terms of cash being generated, activity being forward-lookingly, in a sense, taking a much more linear course. We've seen a sort of a shock to the system. So that means that a lot of these companies would need more cash because there's going to be a cash management issue in this. They might need more capital. They might have a huge disruption in their business lines, which means that some of their businesses may actually not be valid any longer. So it's sort of like a perfect storm environment where 3 or 4 factors are happening at the same time. What's happening is that, all of us, all the sector is deploying help and capital to these companies.
Do you see, because you meant like upstream is harder to raise money, and downstream you're saying that this big liquidity crunch, or this liquidity problem. Do you see different effects on the different stages of growth, like for startups or early growth that you were mentioning to more established? Is there a differentiated type of effect that you're seeing?
Yes, I mean, this is, for example, you were mentioning upstream fundraising is going to be a difficult issue for everybody. We're talking about mainstream, non-mainstream, because it's a very labor-intensive sort of one-to-one contact with investors. And if investors cannot go and see your operations, your members, your companies that you've invested in, and do their due diligence, they're not willing to give you money. So there's going to be a disruption there. A lot of money that's around is what we call dry powder, which is money already within the funds committed, but not yet deployed. But dry powder sometimes predominantly goes into new investments, and sometimes on follow-on investments or on current investments. So if you have a company in your portfolio, you can actually help them raise more capital in the later stages, and that's usually called a follow-on investment. Now, all of that activity, dry powder, is going to be mostly used to shore up defenses for these companies. Fundraising is going to be difficult. For startups, I see a really bleak picture, and luckily we're not mostly active there. But and I'm not talking about impact industry, I'm talking about the whole sector. And startups are going to find it very difficult to survive. Early stage companies, if they have a robust business, and in many cases, the companies that we've picked, they're doing fine, and they are able to face the future with help. Growth stage companies may have difficulty because if there's been a lot of capital deployed into those companies, the expectations are higher, the big ticket sizes are in there, they will have to very fast get out of sort of a catatonic state into a very active state. So there has to be a lot of push from dry powder into making these companies actually survive. So you're going to have different effects on different types of segments.
Right. Shruti is asking, What are some of the challenges that are faced on fundraising? And I will add, especially in Asia, beyond the return or beyond the expectation returns, but with the expectation returns too, to mobilize private capital. So what are the main challenges that you see? How do you make a case for impact investing in Asia? And how do you make it more visible?
Yeah, I think this is a very crucial question, and we've talked about this many times also with colleagues, peers. Essentially, if you look at the VC fundraising cycles, and usually we're talking about VC and PE firms have these structures, they're 12-year sort of investment. The fund's duration is about 12 years. After the fourth and the fifth year, you start actually looking into raising money for the next fund. And then every 4 or 5 years, you're supposed to raise money, that type of a cycle. Now, that cycle has been the same over the last, 60 years. It needs a huge disruption. And I was really happy that the other day when Bamboo Capital was talking about blended finance and looking at different ways of fundraising, we need a big disruption there. Fundraising, regardless of COVID, is an extremely labor-intensive, lengthy process that takes a lot of time to coordinate and do, because you're bringing maybe different investors around the table. It takes time to actually put them around the table. It takes time to converse and understand their needs and translate it. Now, in Asia, the situation is even particularly difficult. Now, if you look at I think there was the slide previously, Vanina, if you can put it up again. This is a survey done by GIN. GIN is the Global Impact Investing Network, and I think it does a really fine job bringing all the information around impact investing. And I would really suggest all of you to look at their publications on their site. This was a survey done a year ago, and it really represents the sort of the breadth of impact investors in the world as a network. 80% of these impact investors, so their members, are actually located in the United States, Canada, and Europe. The rest, 20%, have had headquarters, all around the world. In Asia, we're talking about, and I'm going to exclude Australia from that list, we're talking about maybe a handful, like 15 companies, 12 to 15 companies actually have headquarters there, which means that there's a huge deficit of Asian investors actually supporting Asian investments. Okay, and that is a structural issue, and it's the way that the VC world also operates. The Asian investors, when they look at impact investing, whereas in the West, it was either impact investing was interchangeably used for philanthropic money, which means that sub-market return, or it was used as an exchange for let's boost up sort of speculative investments, which from an Asian perspective, startups and many others may fall into that category. Now, a lot of the Asian investors, when they put their money, if they feel safe about what they're doing. So there's a lot of philanthropic money around in Asia. The Asian high net worth individuals are, we're talking about roughly about 9 to 10 million people above a $1 million income level. And in places like China and India, in Japan, elsewhere, there's a lot of philanthropic money. But that's sort of a chunk of money that they don't want to mix with impact investing. For them, impact investing has to be, a robust storyline, which is that there's impact, but there has to be a return. And the return is very, very important. And they don't want to do, as in the West, mix with philanthropic investments. They don't want to mix it with speculative investments again. Just to give you an anecdote, a very close friend of mine who had an enterprise and education technology company out of Switzerland, and was invested by Asian investors, Southeast Asian investors, and the first thing that the investors told them, they said, we have two rules. One, you're not going to lose any money. Second, you're not going to lose any money.
So do you feel there is this type, because I think we've seen this in traditional corporates too, that there used to be that there is one thing where we do our investor or our business, and business is business, and then there is a mindset where we do the social good, goes in the philanthropic side. And I think we've been trying for decades to break that mindset, and I think impact investing and especially the returns first money is building. And I think there is already, if you look at some research on ESG integration and sustainability, and even initial analysis about the COVID crisis, that companies that care about both and allied bonds actually do better. No? So, but do you still see in Asia, maybe much more than Europe, this siloed type of mindset? And how do you find it? No,
I think you're right, because investors all around the world actually reason that way. But I think there's another, and I'm gonna put it in a I think feedback to the impact community and feedback to those who want to actually get into that space and lure Asian investors. You have to have a very compelling story. The compelling story has to be there. You have to really show value to people. So you cannot rely on their, goodwill and say, oh, you're going to do social and environmental impact. Give me the money and don't think about it. I think in Asia, that sense is much more grounded, and it derives from a very, in most cases, conservative ways of managing family money. And I think, a lot of family enterprises by the first generation or second or third generation, they really cared about how to build that empires. So they're just very adamant about using that money in a very conservative manner. The new generation, so their kids who are actually going to be at the helm in the next 5 to 10 years, the Z generation, as we call it, the millennials, they are actually starting to diversify their portfolios. I have friends, people that I know, who say that their parents are not very happy about this sometimes, because they think that that money may not go to the right places, and I think what we need to do, and this is, you cannot tell an investor you don't understand me. Actually, investor, like a client, is always right. You have to find the right way to really have a compelling story and convince the person that you're producing value for that person. And I think for the sector has to work really, really hard on this.
No, and that's great. And I think we are also going to have a webinar on May 13, if I'm not wrong, with a person from UBS, Jaume Iglesias. Is actually, he deals with high wealth individuals, and he's going to come and talk about how he builds that compelling story. So you're making a perfect transition for the future webinars too. We have a question here from Marianne in the strategic view that you have and how you handle the different regions and different countries. And she's saying, if I'm not wrong, Sorry, I lost it. The chat is moving. So do you see opportunities, for example, for impact investing in education? And how do you, in India, and how do you deal with different topics? So I was also looking for another that was saying, do you look at investing in a region? Do you prefer to put more investments in a specific country? Do you go to smaller countries? Are there any kind of tips or rules on how do you decide your investments? Also, are thematic, or what can you tell us?
Yeah. Well, as I said earlier, we're sector neutral. So we do actually invest in all sectors that fill into that category of serve the underserved. So any sector that actually fulfills the basic needs of people who don't have access to that product or service. So we're sector neutral. And education is part of our portfolio. In India, we have, among many of the pipeline activities that we looked into. There are a lot of education companies, skill building, capacity building around, skills is a very hot topic nowadays. Especially it's going to be even more important post-COVID phase. So we're going to see a lot of new people coming up with ideas, how to actually use technology in that field, how to really skill people for which we're going to see a huge numbers of unemployment and all that, all across the border. So that's going to be a main cause. The way we look at the investments, we might have and this is true for every other impact investing company, we usually have a mandate. The mandate says you can invest in these sectors, in these countries. This is the amount, the percentage of investments that you can do as top in order to have a very diversified portfolio. There are all sorts of compliance limits on what you can do and what you cannot do. So we are, we manage other people's money. So there's a fiduciary responsibility, to fulfill all of this. But right now, when we look at the portfolio, roughly about 40-45% because of size and the opportunities there are is in India, and then we have 30% in Myanmar, and then Pakistan and Cambodia, the rest. If you look at other big firms, comparable firms, they might be located in India and they have 100% in India. They might be sort of more Southeast Asian perspective. So they have Indonesia and Vietnam and Thailand or Philippines. It really depends on the mandate. There is no one size fits all type of
and
view.
Derek is asking, and 6 people actually like the question is, since we talked about the COVID crisis now, what do you think, can this accelerate impact and responsible investment? And if you have seen any discussion in Asia about precisely conditional bailout, for example, and in Europe, there's a lot of discussion these days if governments should support companies with and put certain social and environmental targets, if they should leave sectors outside of the help that we know that are damaging, and they're talking a lot about decarbonization of portfolios, etc. Do you see this same type of push in Asia about thinking how after the COVID crisis, impact and responsible investment can come reinforced?
Sure. Let me unpack that question because there are a couple of sides to that question. One is that with the COVID crisis, where's the money going to go mostly? Is it going to go into impact investing? If you consider healthcare and the response to COVID as part of an impact sphere, yes, we're going to have a lot of money going into COVID related. And already, Bill Gates Foundation, the Gates Foundation, many other foundations, especially the US-based foundations, already announced huge commitments to fight against COVID. Part of the money will be earmarked, and I think more so than right now, for the Western world. Paradoxically, what we're seeing right now, the vulnerability of the sort of Western liberal economies that were based on private initiative and private wealth. With a lot of people being unemployed, problems mounting up, the bailouts and philanthropic money, there's going to be a lot of money going in there. Now, so the way I see it, in the next 1-2 years, we're going to see less money circulating for other activities, non-COVID or non-Western. Mm-hmm. The earmarked funds who have a destination for emerging markets, Africa and Asia, they will keep on investing. DFIs, I think, we're not going to cut their investments. DFIs, being the big international sovereign or multinational
development finance institutions.
Development finance institutions. They will keep on giving money, but I see a rough market for 1-2 years around, where the money is going to be deployed, which is going to make, fundraising difficult, which is going to make a lot of things difficult. That said, over the course of the long run, I think the generational change and how much people care about social and environmental issues, the types of disturbances that we're going to see in many countries because of the collapse of the economic system, you're going to see more money actually going into these endeavors, but they're not going to be exactly like what we're looking at. And I hope, models such as blended finance and all that will take place. Asia has not yet announced big bailouts, except a few countries here and there. And the big preoccupation in the West, at least, on paper, but in reality, that doesn't happen. Let's give money to those create social and environmental impact, and let's not give money to impact companies, mainstream companies. I think that is not, that discussion is not being held right now.
As you're mentioning, I think probably the post-COVID world, this part of ecosystem building and collaboration with developmental financial institutions, philanthropic money, private money, government, etc., collaboration will become more and more important. No, and we had a webinar last week with Fabio Segura about the corporates in the cocoa industry collaborating with philanthropic money to actually fight child labor and quality education. And next week we will have another incredibly webinar of how to put different players and even a large commercial bank like BNP Paribas. So how do you see acting actually in Asia, fighting deforestation? How do you see this part of the ecosystem building in Asia? And what takeaways from what we talk all today you want people to have from this? How do you think this environment of the ecosystem will evolve in Asia, and what can we do to make impact investment much more present, since you said still impact investors in Asia and a minority of impact investors?
Yeah. Yes. Well, first of all, what we need to, as I said, really focus on a compelling storyline. We have to make our purpose really well known. We have to have a good track record. It's a very young industry, especially we talk about impact investing. It has a history of maybe 10 to 12 years. You don't still have a big sort of data base to really judge whether the yields are the right or the types of impacts that it's measuring is actually on a long-term basis creating such impact. So it's a very young industry. In order to really look into the future and say, okay, give me more money because I'm going to do more good, we have to have built a very compelling storyline. And that part of it is metrics, and the other part of it is, telling the stories and making sure that the ecosystem in a very sort of coordinated manner tells the stories of people who get impacted by this money coming into the market. This is, I think, very, very important. And in Asia, even more important so. Because there's a lot of philanthropic sense. If you look at the Asian countries, there's a famous index called the World Giving Index. It looks at different factors that whether in each country if you look at places like Indonesia, elsewhere, where there's a big sort of religious, faith-based Islamic finance, or there's a lot of money actually there, and the monies are being used to actually help people. I don't know how much of the money is being actually measured within the impact investing cluster of money, and how much of that is being deployed to the places that it has to go. Likewise, in India or in China, there's a lot of philanthropic activity, but where's that money going into? So we have to be very, very adamant about making sure that we actually create a compelling story. The other, learning for us is that you have to have a very robust investment process, with exit in mind. While you sort of look at it from a social and environmental lens, you also have to create a very robust investment case. And this is true for the Asian investors, and I mentioned that earlier. The another learning, and this is, I think, all of us will have to adhere to, is that, this is a very lengthy and very labor-intensive process. You're putting around the table a lot of people who have different interests and different, they come from different geographies, they have different vested interests. Finding a common ground takes a lot of time. And so you have to be very able in terms of managing the expectations of investors. Investor relations, in a way, is going to be a hugely appreciated side of this business. And I think the impact investor has to really start the intermediaries and others who are actually money, and even the home offices. They have to really look at it purely from managing stakeholders and investors. So and building teams. A lot of young people want to go into the sector. A lot of people who are like myself have had their careers in banking industry, in consulting houses like Bain and Company, who after many years would like to give back. They would like to go back and give back. So there has to be a very clear sense of building a team around purpose and finding the right people who can juggle around. We're talking about investor relations, investments, building storylines. So you need artists, you need creative thinkers, you need finance people. It's a very interdisciplinary world.
So thank you very much, Sertac. The time is up, and I think what you're saying will appeal to a lot of our people in our audience. There are also IMD MBAs that will be looking for a job pretty soon, and many of them I know they're interested in the impact finance and in the sustainable finance sector. And again, I want to reiterate the invitation to all of you to be part of the community, to join us at the ELEA Center, or to write an email to me or to Patrick, and to actually become part of the community if you want to share your own story. And next week, we're also going to have, as I mentioned, another webinar. Here you have my contact information, but another webinar where we'll talk a lot more about these details that Sertac addressed, that the difficulties of collaboration, because we strongly believe that the collaboration from different stakeholders, different sectors, we will support the impact investment drive and the mobilization of private capital. We somehow have some of the tools now to know how we spark social innovation or how we innovate, but we're still having some trouble on scaling up and speeding up the process. And I think after the COVID crisis, and many of you asked questions about that, speed and transformation are going to be a key. And next week, we're going to talk how also these collaborations can help corporate transformation. So we'll move from the more general to a grounded example with BNP Paribas, Michelin, and other key players. So thank you very much, Sertac, for your generous participation and the very interesting discussion. And we look forward to future collaborations. And thank you, everybody, for staying with us. And I hope I see you next week. And thanks so much.
Thank you. Have a good day.